Hello, good evening, everyone. Thank you so much for waiting, and really sorry that we started slightly later than 7 p.m. Thank you so much for joining us this evening, and welcome, of course, to the third installment of Mastering Your Finances webinar series. So before I begin, what you see here on your screen is a QR code that you can scan if you'd like to actually get in touch with our client experience team. We're happy to walk you through any sort of concepts you might actually learn today, hopefully, and take away today. Or if you have any questions about Stashaway in general, please feel free to reach out to us. So once again, my name is May. Welcome to our third installment for Mastering Your Finances webinar series. Once again, thank you so much for joining us tonight. Apologies, we started a little later than 7 p.m. So if you have joined us last week and the week before, for our first and second webinar, welcome back. Once again, my name is May, and I am part of the client experience team here at Stashaway. So in the last 2 weeks for sessions 1 and 2, we've spoken a lot about personal finance and how we can essentially build a strong foundation. We've also gone through some investing basics and why risk management is an important element in long-term investing. Today, we're actually going to talk about navigating market volatility with confidence. Now, investing exposes you to risks, which in effect affects your portfolio performance. That's just the reality, right? So risk is mainly due to the volatility in the market as well as the macroeconomic environment. Today, we're going to talk through volatility and how, first of all, DCA can help. We've also spoken briefly previously about diversification. So today, we'll dive a little deeper into this concept and diversification of portfolios beyond asset classes. Now, the last thing we'll look at today is the Singapore Supplementary Retirement Scheme, or SRS for short. Now, it's a scheme many have heard of, but am not familiar with. So we'll be doing a 101 on SRS later on. So hopefully that will give you some clarity on this scheme. Again, if you have any questions at any time, please feel free to use the Q&A chat function that Zoom has. My colleagues are available to help, and I'll also take some questions at the end. We're also live on YouTube. So if you have any questions, please feel free to use the YouTube chat box you see at the side of your screen. We will definitely get to your questions, and my colleagues will also, once again, help to answer any questions that you may have. Now, before we begin, as usual, let me start with an introduction to Stashaway. So we're Asia's leading digital wealth manager. We were founded in Singapore in 2016 and have since expanded to 4 other geographies. Now, these geographies include Malaysia, the MENA region, Hong Kong, as well as Thailand. So essentially what that means is that we're licensed in 5 different jurisdictions. And as of 2021, we have over $1 billion US dollars of assets under management. Some of our backers include Sequoia, Fidelity, SquarePeg, as well as Hamilton Lane. And we've also received numerous accolades over the years, with 2 of the more recent ones being named as one of Asia Pac's high growth companies by Financial Times, as well as amongst the top 200 global fintech companies by CNBC. Over here, we have an overview of our suite of products for our users on our Singapore platform. You would be able to explore this on our app itself. All our products have no minimum amount requirement and no hidden costs, so it's an extremely convenient tool to get you started, or it can even be part of your current investment and retirement plan. So if you've already downloaded the app, feel free to explore the products and interface. And if you have any questions at all, once again, our team is always available to help. We're at support@stashaway.com. Once again, we're at support@stashaway.com. Now, moving on to the meat of today. There are 3 topics we're going to cover today. We'll start with market volatility, which is honestly a scary thing for a lot of people. I mean, seeing your investments in a green one day and then red the next is really not a nice feeling. I understand that. We'll talk through this and try to make sense of what market volatility is. And then we'll dive a little bit deeper into the concept of dollar cost averaging, or DCA. So once again, for part A, we're going to be looking at volatility and how DCA helps. Now, to start, we see 2 charts here of what once were 2 of the hottest assets, still are to a lot of people, Bitcoin as well as Tesla. So we saw their prices go through a massive uptick due to positive sentiments in the market. Now, due to these sentiments and stories of course, overnight millionaires who made double or essentially triple of their initial capital through trading these 2 assets, it is very tempting for someone like you and me to want to take a position to hopefully continue riding the wave up. I mean, it does sound quite easy. You buy an asset and then you sit back and watch the chart go up and up to the right. Here's the reality though. Right after this peak, there was a market correction, and those who entered at the peak with the hope of an uptrend or a continued uptrend, like what they had heard about, experienced a big loss. But if you think that this is a ploy from us to just scare you off investing in individual stocks, it's not. But I'm also just here to show you that in reality, markets are a lot more volatile than a lot of people think. And the markets can also cause one to be extremely emotional, which then leads to the investor acting irrationally, either panic selling or buying because of FOMO, both of which are really highly not recommended. Now, despite volatility, if we were to zoom out, so if you see here, this is a chart of the S&P 500. Um, Markets have always historically trended upwards. And volatility are part of the bigger investing picture. So as you can see, despite trending upwards, you do see drops because there's a lot of volatility, but actually in the last, I believe it's like 20, 30 years, the S&P 500 on average has returned investors 9%. So no matter what you're invested in, there will always be some sort of volatility. This again is a chart of the S&P 500 since 1983. From then to 2023, there have been dips, trends up, followed by swings down. This is all volatility. However, over the years, again, on average, markets have always trended outwards. Now, a few things to note that while this is the case, before you start investing it in an asset, it is crucial for you to be sure what you'll be investing in, number one. Number two, it's extremely crucial that you're also comfortable with the potential risks that you're exposing yourself to. Now, once again, the goal is not to scare you off investing. If anything, we're here to help boost everyone's confidence. So let's go through and try our best to make sense of what volatility actually is. First, price swings. So as we saw in the charts of Bitcoin and Tesla early on, market volatility is characterized by rapid and sometimes unpredictable price swings. Asset prices can change dramatically in a really short period of time. And this is what makes markets highly volatile. For instance, a stock's price might surge one day and plummet the next. Now, what causes these price swings? Various factors. But some of the more obvious ones are potential market and economic data. So, for example, interest rate change, employment data that is released by governments. Unexpected news could be an announcement that's different from what consensus had been expecting, or any sort of geopolitical events like conflicts. So, events and news can trigger a sudden spike in volatility as investors may engage in what in the industry we call knee-jerk reactions, like selling just to avoid the volatility. So the moment news is announced, regardless of whether good or bad, investors tend to act on it extremely urgently and immediately. So the moment there's bad news, say for example, company A announced something at first to what the media was expecting or what analysts was expecting, investors would basically hurry to sell their holdings in that particular share, which then causes the price to drop. But say, for example, company A actually announces positive news and it's a lot more positive and better than what was expected by the media as well as economists or as well by investors, then people will rush in to buy, and then that causes the price swing up. So this is what is an important factor to note, what causes these sort of market volatility. Now, how do we measure volatility? This is slightly more technical, but I'll do a quick run through two commonly used indicators in case you're interested to dive deeper into this later. So there's standard deviation, which essentially is a measure of how much an asset's price deviates from its average price over a specific period. So there is also a volatility index or VIX index. This is actually something you can trade in the open markets on the stock exchange. Now, this index is actually very, very commonly known as the fear index, and it's actually a real-time index representation of the market's expectation of a 30-day forward-looking volatility. Now, in both instances, a higher standard deviation or VIX index is indicative of greater volatility and increased market certainty. Now, market uncertainty, sorry. Now, this is, of course, very, very technical, but I'm just leaving it here on the screen if you'd like to actually research and look into this further yourself for knowledge. Now, how can we actually, what are some of the impacts, what are some of the impacts on risk and return? Now, more volatility means higher risk, which means a higher chance of losing money. Now, for some, volatility does also present an opportunity for them as they believe high risk means high returns. Now, it could also lead to large losses, so always be careful. There is some truth that high risk does lead to high returns, but this also largely depends on your timeline. Now, if you have actually tuned into our webinar last week, we did actually run through how you can sort of think about risks as well as your timeline. So if you're looking to perhaps invest for a longer time period, perhaps you can take higher risks, maybe invest directly into equities, because as I've shown the graph before, historically markets have always trended up. So if you have a longer time period, you might be able to actually expose yourself to higher risk assets or invest in higher risk assets. But if your timeline is a lot shorter, then you might want to consider lower risk assets like bonds or fixed income. Just because, say, for example, you have a shorter term bond to, say, buy a car in the next couple of months, and you want to actually put this cash to work first and not just sit idle, in your bank account or, somewhere where it's giving you very low yield, then maybe you want to consider investing in bonds, because bonds are not as volatile as equities or a higher risk asset. That means, when it comes time for you to perhaps withdraw and use that cash to purchase whatever it is you need to actually shell out the capital for, you will not be at a loss. That means, your capital at least is still at the same amount that you perhaps had actually deposited initially. And you would also have hopefully additional yield on top of that capital. Now, how can we actually measure our risk exposure when investing? There are a few strategies. Diversification and dollar cost averaging are tools that I personally believe strongly in. Adopting a long-term perspective when investing also helps eliminate the emotions associated with investing, as basically you would be less affected by volatilities happening in the shorter term, especially in the market. So if you're like me, having a longer term perspective also makes you see market dips as opportunities to invest more cash in to average the cost of your existing assets down. So actually, I'm someone who's very excited when markets are actually trending lower or when markets are down, because I feel like that is an opportunity for me to actually deploy more capital into buying a specific asset that I probably had my eyes on and decided that it was too quote unquote expensive at a certain point in time. And when the price comes down or when there's a price swing down, I actually see it as an opportunity for me to either double down if I already have that asset, or perhaps take a new position. So this also helps you avoid any sort of panic selling, as well as exiting the market. Lastly, it's also important to be aware of general investor sentiments, as this also affects volatility. Now, extreme optimism, or there's a term for it called irrational exuberance. It's actually coined by a famous economist called Robert Shiller. It is when an investor enthusiasm actually drives asset prices higher than those assets' fundamentals justify. So it's buy, 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 buy for everyone. And then on the other extreme, panic, which causes massive selling, that leads to price swings and volatility. So these are a couple of factors for you to hopefully sort of make sense of volatility. And I hope this also helps to shed some light on what market volatility is, to give you a little bit of background as to what market volatility is in general. Now, despite knowing all this, as humans, we would sometimes allow emotions to get the best of us. If markets are low, we'd probably think to ourselves, okay, it can go lower, so I'll wait to enter the better price. And then prices go back up and we tell ourselves, nah, it's too expensive. I'll wait for it to drop. And this happens to everyone, happens to the best of us, right? Now, this is what we call trying to time the market. And with so much noise around us, as you can see in this graph here, you will never find the right time. Through all the noise, the market has also moved its own way, but ultimately, as I mentioned, it trends upwards in the long term. If you had waited to enter, you would have missed opportunities because you felt that you would be able to enter at a better price. If you had also listened to all the noise, staying out of the market, selling, not having a consistent investment plan, you would have also missed many opportunities. Now, just bear in mind that all these headlines you see here by the media, the media only has one job, and the KPIs is really just to sell you newspapers. It's really to sell you subscriptions. So ultimately, headlines are one thing. You need to be comfortable in the asset that you are invested in. You need to have conviction in the asset that you're invested in. And ultimately, you also need to have a goal that you're investing toward. So here is some data that I have also shared in our last webinar. So in case you missed it, this actually helps me drive my point home, right? So when you have a consistent investment plan and you're investing in assets that suit your risk profile, you'd be comfortable to stay invested through the volatility. So as the graph here shows, if you invested $10,000 in the S&P 500, kept your money invested in the markets, even through the greatest recession in recent memory, which is the COVID-19 last couple of years that we experienced together, you'd still have roughly made 650% in returns. This means if you had actually deposited $10,000, as I mentioned, S&P 500 on average has given 9% returns. Over a 20-year period, you would have roughly made 650% of your capital, all without lifting a figure. Even if you had just missed 10 best days in the market, and that's 10 best days over a 20-year time period, right? So 10 days over a 20-year time period, you would have lost out on 350% of potential returns. Once again, when you zoom out, history makes it very plain to see that by staying invested, you're letting your money grow alongside the markets consistently. Now, moving on, I had spoken a lot about having a consistent investment plan and being disciplined with putting money aside on a weekly, bi-weekly, or maybe monthly basis toward your investment and financial goals. Now, a question to the floor right now. Please feel free to use the chat box on Zoom. If you're on YouTube, please feel free to use the YouTube chat box you see on the side. I just like everyone to sort of share, with us, how often do you actually set aside money into your investments? It can be weekly, it can be bi-weekly, monthly, or maybe even what your ideal frequency should be. So I'll just take a pause here to allow everyone to perhaps, share some of their thoughts in the chat. Okay, we're seeing some answers coming in. Some people do weekly. Monthly, okay, someone sharing. Every time I get my salary, I deduct my budget for the month, some savings in cash, and the rest is invested. Okay, no, that's actually a really, really good habit. That's actually something I do as well. Sometimes monthly whenever I have excess income. Okay, I understand. So generally, there is no silver bullet and there is no right or wrong. It basically also really depends on your circumstance, right? Used to be monthly until I read your article, switched to weekly investment. Wow, thank you so much. We'll let our marketing team know that our messaging and what we're actually trying to share and get people to do, hopefully create good habits, is actually working. So that's actually really, really good to know. Thank you so much for that. Yeah, as I mentioned, there's no silver bullet, there's no right or wrong. Ultimately, it also depends on your circumstance, right? Like if you have some money that you feel you can set aside on a monthly basis, by all means, go for it. If you're someone who gets paid weekly and then you decide, you know what, every week I want to set aside maybe, let's say, $200 into a specific portfolio, that's also fine. For me, I have a standing instruction for monthly deduction. And then as I went during the month, if I feel, I want to put more money into a specific asset or a specific portfolio, I do so. So it really depends on your circumstance, and everybody's financial journey is very different. I think the important thing is to really establish the habit and be disciplined about it. If you had decided, and this is something that I've said many, many times. So if you've tuned in the last 2 weeks and you've heard me say it, bear with me. For those who are new here, this is something that I do actually tell everyone, even my friends and family. If you had essentially decided that, you know what, every month I'm going to set aside let's say $1,000, right, to put into my investment portfolio. Unfortunately, this month you had excess expense, you had to buy something that was very expensive and you had to eat into that $1,000 and you only have $500 left. Don't leave it until next month to put in the $1,000, right? Even if it's below what you had initially budget, don't stop investing. Put that $500 to work. Put that $500 into the investment portfolio. The important thing is for you to not stop. What we're trying to drive home here is that, you don't want to stay out of the market. You want to be in the market. You want to make sure that your cash actually works for you. So I have always mentioned the series that for investing, again, as I've said, there's no silver bullet. Everyone's financial circumstance is different. I know I'm starting to sound like a broken record, but more than how much you have to start investing or how much you have to set aside every month, the discipline, again, to consistently invest outweighs everything else. One concept that we strongly believe in is dollar cost averaging, or DCA for short, right? So I'm going to use DCA from now on. Now, DCA is the act of basically investing regularly, regardless of the asset's price. So you set a specific schedule that you're comfortable with, put aside a specific amount of money, and sit back and watch your investments grow. Now, this helps you take the decision-making cognitive load off your investment and frees up time to allow you to pursue other tasks. Now, how does DCA actually work? First, an investor decides to allocate a specific amount of money, typically on a regular basis, to purchase a particular asset. Now, this consistency is entirely dependent on your circumstance, as I mentioned, and comfort level. So it can be weekly, bi-weekly, monthly, every 6 weeks, depending on what you're comfortable with, right? Now, regardless of whether the assets prices are high or low, the investor invests the same fixed dollar amount during each interval. So say we had planned to set aside $1,000 every month into your investment. However, markets can be volatile and the preferred assets price will also vary. This means that when prices are low, the investors buy more units of the asset, and when prices are high, you buy fewer units. However, despite the variation of price at every entry level, by actually consistently investing over time, dollar cost averaging basically helps spread the investment risk and can mitigate the impact of market fluctuations. For example, when prices are low, the investor acquires more units, potentially benefiting from future price increases. Lastly, dollar cost averaging is one of the core fundamentals for long-term investment. DCA basically encourages discipline and removes the need to time the market, which can be challenging to do consistently. In fact, I think it's virtually impossible for you to do it right. So here is actually a real life example of what consistent DCA into a portfolio looks like. This is actually one of our colleagues' portfolio. She's been very disciplined with her deposits, regardless of where the markets are at for the day. And as you can see, despite the ups and downs she experienced in her portfolio value, in the end, it's a continuous step up in terms of growth of her investment. I know that sometimes life gets in the way. I had just mentioned this. If you had intended to set aside $1,000 every month, but again, due to unavoidable situations, you're only able to set aside 500, maybe even just $100, that's okay. Just don't stop. As I've mentioned many times, and I'll continue to mention this, more than the amount, it's the habit that helps build your nest egg. Some months you may have more, you can then add in more to make up for months where you have fallen short. Trust me, the consistency does pay off in the end, and your future self will thank you. Now, let's move on to the second part of this webinar. We'll be talking a little bit more about diversifying your portfolio. So we've spoken extensively about asset allocation and why that's great for diversification. But today we'll take it one step further and explore diversification beyond asset allocation. So diversification, which I have already shown just now, very simply, and as a reminder to everyone, it means you spread your investments across different types of assets to lower your portfolio risk. Now, why do we diversify? As you can see in this chart here, it's because not all assets move in tandem with each other. So here's an example of a conservative portfolio. This is actually a split of assets you will be exposed to via Stashaway. Now, if you were to pick a lower risk general investing portfolio to invest in, as you can see, you would potentially have higher exposure to lower risk assets like fixed income and cash equivalents. Cash equivalents here are treasury bills and cash itself, fixed income bonds, both of which are much lower in risk compared to equities, to which is still worthwhile having a tiny exposure to, in addition to commodities to balance out the volatility. I just want to share that despite the pie chart you see in front here, even within equities itself, it's extremely diversified, right? You have global equities, but even within that, you are exposed to perhaps equity in Japan, in India, perhaps certain sectors as well. Even in bonds, you are also exposed to government bonds or corporate bonds. So there is also diversification on an asset level. These are just some of the content of the portfolio itself. But let's go to portfolio at the other end of the spectrum, so slightly higher in risk, right? Again, it's another example of an actual Stashaway portfolio. So as you can see, the exposure here leans a little bit more toward equities. Then we have less significant exposure to fixed income and cash equivalents with an allocation to commodities to balance out the risk. Now, as you can see from the two examples that I have just shared, depending on your risk tolerance, you would be able to adjust your risk exposure to different assets as part of an overall risk management activity. Now, let's go through the four main benefits of diversification. First up, risk reduction. Now, diversification definitely helps to mitigate the impact of individual investment losses on your overall portfolio. So when you spread your investments across different assets, the poor performance of one investment may be offset by the positive performance of others, right? So this reduces the risk of a significant loss And diversification basically lowers the overall volatility of your portfolio. So when you hold a mix of assets with different risk profile, the portfolio's value is less likely to experience any sort of extreme ups and downs. So you're also less likely to panic or make any sort of impulsive decisions during market downturns, right? And this can make it easier to stay invested during any sort of market turbulence. Now, with a reduction in risk, this also means that your portfolio will experience steadier returns. So while any sort of volatility is unavoidable, remember this, please remember this, that we can only minimize risk. We cannot completely eliminate risk. So if someone comes to you and wanting to sell you something that they tell you is risk-free, run as fast as you can in the other direction. Because the key thing with investing and the key thing to remember is that we can only minimize risk. We cannot ever eliminate risk. Now, a diversified portfolio is definitely likely to exhibit more stable and consistent returns over time versus, say, for example, if you had 100% exposure to equities. Now, as I just mentioned, while some assets may experience fluctuations or underperformance, others may perform well. Now, this smoothing effect definitely can provide a more predictable investment experience. And in the longer term, this helps with the preservation of your capital. How does it help? So if a portion of your portfolio suffers loss, the gains in other areas can help offset those losses. And this prevents a significant erosion in your initial investment. Third thing is that you'll also be able to gain a much broader exposure with diversification. Now, this is not just across assets, right? But as I mentioned, across industries, across geographies. And I'll talk about this a little bit more later on. And spoiler alert, if you do it all via ETFs, you will also be doing it at a significantly lower cost. And of course, lastly, with diversification, you're reducing your concentration risk. Now, without diversification, a portfolio may become heavily concentrated in a single asset or sector. Concentration risk can be dangerous because if that asset or sector experiences downturn, the entire portfolio suffers. Now, beyond diversification of assets, sometimes there are areas and trends in the world that we may have an interest in gaining exposure to. Another question to the floor. Once again, feel free to use the chat box if you're on Zoom, and the chat box if you're on YouTube again. Is there currently a trend or industry that you're excited about and interested in perhaps having some sort of investment in? I can share. Personally, I'm super excited by AI. I think it's really cool to be living in an age where things can be automated in that regard. So I'm just curious to know if there's any sort of trends or industries that you guys are actually looking at this point in time. Semicon, yes, a very hot and trendy sector. Okay. Some people have said healthcare. Interesting. Yeah, I mean, there's a lot of sectors going out there, some crypto. So a lot of very different sectors out there. And it's very interesting, especially when you have the opportunity to diversify into these sort of sectors and have some sort of exposure to them, right? Because ultimately, if you think about it, if you had the chance to bet on something for the next 10, 20 years, like what would that be? That's actually something very exciting to think about. And it's a topic that I kind of geek out with my friends as well. Now, let's just kind of move on a little bit, right? So throughout today's webinar, you've heard me speak a few times about diversification beyond asset classes. Now, what does this mean? Now, diversifying beyond asset classes is basically structuring portfolios around specific themes or trends that you may personally be interested in. So there are some people who say semicon, there are some people who say AI, like myself. There's some people who say car, automotive, and healthcare and crypto. So why do we do this? Now, this could be because you feel that these sectors or trends align with broader economic and societal developments and have huge upsides in the future. And there are various ways to structure these portfolios. They can be sectorial, they can be geographical, or they can be based on certain beliefs that you may have. Now, here's an example of a breakdown of some of these and what we call here stashaway thematic investments. So if you're optimistic about Japan, for example, which I actually am, you can select assets that give you a broader exposure to Japan. If you're passionate about sustainability, perhaps something ESG related might suit your fancy. If you're just looking for specific yield generating assets, then a portfolio diversified across yield generating assets would probably be more suitable for you. Now, with such a way, besides asset allocation, we do believe that you should be able to diversify outside of the traditional portfolios into these thematic portfolios. Now, these are also some real life examples just to give you guys a sense of what we mean when we talk about diversification beyond asset classes, right? So on the left here, you would see portfolios available to individuals who would like to generate passive income through yield generating assets. And on the right, if you're passionate about AI, blockchain, and the future of tech in general, we also allow you to get exposed to these up and coming sectors via ETFs. Sustainability and climate change is a huge topic nowadays and actually quite popular among quite a significant amount of our clients because we all want to know how we can help in the endeavor to minimize the effects of this for future generations. So that's why we have also established two different ways for our users to gain exposure to companies who are working hard in the clean energy, waste management, and EV space. Of course, with our flexible portfolios, you also be able to adjust the allocations of the assets you like to expose yourself to and create a portfolio that aligns with your personal beliefs and values. Now, here's an example of some of the themes on our platform that is worth you considering getting exposure to. And as you can see here on the familiar graph, you'll be able to diversify your holdings across the different portfolios we have available for users on our platform. Now, I will take this further and touch briefly on some other offerings we have for accredited investors here in Singapore to diversify outside of the standard investment portfolios. So in Singapore, we do have some private equity, venture cap, angel investing, and private credit opportunities for accredited investors, in line with, of course, MAS's requirements, and an option for a crypto add-on, crypto ETF add-on onto their portfolios. Again, this is only for accredited investors, but I just want to run through some of the basics of this to just show you that there are options to diversify outside of asset allocation and give you a little bit of a taste of what alternative investing really is, right? So private equity and venture capital, as well as angel investing, you do require a longer timeline. And the general timeline for private equity is anywhere from 7 to 10 years. Angel investing obviously is dependent on the success of the company. The risk factors surrounding private markets are definitely different than standard market risk. Now, for private equity, or PE for short, venture capital is VC. So for PE and VC, one of the biggest risks is obviously illiquidity. For angel investing, one of the risks is that there may not be much information on the company because of the short market history, which also means that there is an unproven product market fit. The logos you see here are some of the biggest funds in the world, which we help our clients gain exposure to. Again, at this point, they're only available for accredited investors, but I do want to take the opportunity today to run through a little bit of private markets just to help you sort of make sense of what it means to diversify beyond like a standard portfolio. Now, if you were to look into private market funds in the future, here are a few things you definitely need to know. First of all, ensure that you ascertain the quality and reputation of the team that manages the fund. Any sort of past performance is obviously not an indication of future performance, as it's an extremely high-risk space, which then brings me to the next point, which is, of course, making sure that this ties into your own personal portfolio targets. So be sure to do your research so that you understand the investment strategy of the fund and the key terms of the fund before you actually invest. And if you are currently in AI looking for alternative solutions, you can always reach out to our team at support@stashaway.com. If you want to find out more, you want to learn more, you can also reach out to support@stashaway.com. We're happy to actually sort of walk you through what private markets mean, and if that will be actually a good addition for you at this point in time. Now, moving along to the last part of today's webinar, I'll be touching on a popular request from our users here in Singapore, which is the Singapore Supplementary Retirement Scheme, or SRS for short. Now, bringing this umbrella of fund sources back, when we are in retirement, the one thing that most of the population may rely on is either their pension plans or any sort of retirement schemes that they may have set up for themselves during their younger days. Today, we'll touch on SRS, right? So what is SRS? So first, let me run through CPF if you're here in Singapore. CPF, or the Central Provident Fund, is one that many of us are familiar with here in Singapore. It's a compulsory contribution for SG citizens or PR. As an example, if you currently have a monthly salary of 4,000 Sing, 20% of this will go into your CPF monthly, and then there will also be some contribution from your employer. And all this is locked up until you are 65. Now, for SRS, the difference between SRS and CPF is that SRS is completely voluntary. One common thing that we hear about is that people often confuse it and think it's only either for citizens or PR, or it's only either for foreigners in Singapore and citizens and PRs are not eligible. The truth is, if you are currently residing in Singapore and you are a tax resident in Singapore, you are eligible for SRS. Now, the only difference is the max amount of contribution that a PR or a PR and citizen versus a foreigner can actually contribute to, right? So the max amount a citizen and PR can contribute to in a calendar year, so January to December, is $15,300. And this is on top of their monthly compulsory CPF contribution, right? So CPF is compulsory. This is entirely voluntary. While for non-citizens and PRs, you can contribute up to $35,700 a year. Once again, this is calendar year, so January to December. Once the clock strikes midnight and it's January 1st, it's already a new calendar year. Now, an SRS account can be opened through the three main local banks. So DBS, OCBC, or UOB, and you are only allowed one SRS account. So if you already have an SRS account with one banking provider, you will not be eligible to open it with another one, with another banking provider. Why is SRS so attractive? One of the main benefits of SRS is that your contributions are tax deductible. Your funds are locked in until age 62. So if you had started an SRS account, I'm getting feedback that the sound is a bit soft. Let me know if that's still the case. Let me just click a couple of buttons. Oh, okay, sound is fine for some people. Okay, no, thanks for that feedback. Perhaps you might want to adjust because it seems to be fine. Yeah, if you have any issues, please feel free to let us know. Okay, so let me kind of go back to this. Why is SRS attractive? One of the main benefits, obviously, tax deductible. Your funds are locked in until you're 62. So you started an SRS before July 2022. If you had started your SRS account after July 2022, sorry, let me kind of go back a little bit. I lost my train of thoughts there. So your SRS funds are locked in until you're 62 if your SRS account was started before July 2022. If you started your SRS account after July 2022, it would have been 63 years old because that was when Singapore actually changed the statutory retirement age. Now, all withdrawals made after the quote-unquote maturity date, which is the lock-in date of your SRS, so it's either 62 or 63, will have a 50% tax concession. Now, what does this mean? This means you will actually be taxed on only 50% of your withdrawals. Now, I will go into detail on this tax concession later on. And if you actually decide to withdraw before the quote-unquote maturity period, you will actually need to pay a 5% penalty. And you will also be taxed on 100% of the amount. So I'll run through all this. It sounds quite complex now, but I'll run through all this slightly later. Now, let's look at how much tax one can save with yearly contributions. This simulator you see here is actually available for you on our website. So my colleagues will actually put a link in the chat box. Let's assume a citizen or PR with an annual income of 150,000 wants to contribute to SRS and would like to know how much tax they can save on an annual basis. Now, assuming they max out their contribution, which is $15,300, they will be able to save about 26% on their tax bill. You see the difference between how much tax you would pay with SRS and without SRS on the bottom right of the screenshot. What about a non-citizen or PR? Now, assuming the same income bracket and also one who moves out, who maxes out on their yearly contribution, they would save a whopping $5,000 every year on the tax bill. Now, that's about a 41% worth of tax savings. Again, if you'd like to understand more about this, we will send the link in the chat box shortly so that you can also explore this during your free time. My colleagues will share them shortly. Now, let's consider a contribution plan. Perhaps the sum of either 15,300 or 35,700 seems pretty large, but if you break this down into a monthly contribution, it is easily achievable. You're essentially dollar cost averaging if you're also investing these funds. Now, let's look at the 50% tax concession. That was quite complex, so let me sort of break it down a little bit. Here we have Rachel. So for the last 20 years, she has been very disciplined with her SRS contribution. Every year, she would contribute the max she can of $15,300. that in total over the last 20 years has amounted to a total of $306,000. Now that she's 63, she has two options: withdraw it all in one go or stagger the withdrawal across 10 years. Now, if she chooses to withdraw all 306,000 in one go, she can. She will, however, be taxed on 50% of 306,000. That means she will be taxed on 153,000, while the remaining 153,000 can be withdrawn tax-free. If she chooses to stagger her withdrawals, she can as well. But the max number of years that one can actually stagger the SRS withdrawals in is 10 years. At the 11th year, you actually have to withdraw everything. Now, after the 10th year, you would then be taxed on, that significant amount. Now, do bear in mind with the 50% tax concession, one can actually withdraw in Singapore up to $40,000 a year tax-free. How does this work? The minimum annual salary before an individual actually can be taxed is above 20,000 per annum. So if you stagger your withdrawal across 10 years, and if your withdrawal amount is $40,000, you will only be taxed on 20,000, which is 50%. And that amount is not taxable in Singapore. So if you plan and you say, you know what, on a yearly basis, when I'm retired, I spend an average of only 40,000 a year, slightly under 40,000 a year, then you can stagger your withdrawal over 10 years and perhaps just withdraw 40,000 a year, and that will be tax-free for you. Now, this may sound confusing. Let's look at the summary of the withdrawal logic for SRS, right? So in the event of a premature withdrawal, you will actually be taxed 5% on the whole amount. With premature meaning for citizens and PR withdrawing before the retirement age. Non-citizens and PR, sorry, I forgot to add this important point. Non-citizens and PRs, if from the time when you started your SRS account to the 10th year you have your SRS account, you're not a citizen or a PR just yet, you can actually withdraw your money without the 5% penalty. And you're then also subject to the usual rule, which is the 50% tax concession. So let me kind of go back a little bit more to avoid confusion, right? For citizens and PRs, when you start contributing to your SRS portfolio, you are essentially quote unquote locked in until the statutory retirement age. For a non-citizen and PR, from the time when you started your SRS account up until the 10th year of your SRS account, if you're still not a citizen or PR, or you were never a citizen or PR during that time 10-year period, you can already start withdrawing. So you're not locked in actually until the statutory retirement age. And then the withdrawal rules of the 50% tax concession is applicable to you at the 10th year itself. Now, if you withdraw at the statutory retirement age or on the 10-year mark as a non-citizen or PR, the tax will be on 50% of the withdrawn amount. Once everything has been withdrawn, if you choose to close your SRS account, it cannot, or if you choose, sorry, once everything has been withdrawn, or if you choose to close your SRS account, sorry, if you withdrew before the maturity date and you paid the 5% penalty, you can actually top up your SRS again. You can withdraw up to 10 years tax-free, with the remaining 50% being taxed at the end of the 10 year. Sorry, I didn't mean to confuse you there. Now, if you're someone like Rachel and you have had the discipline to be consistent with your SRS contribution, chances are that you are an investor with a long-term mindset. However, if you were to just allow your SRS to sit in the SRS account, you actually would only be yielding 0.05% per annum. That's actually the latest data that we have. So you heard me right, 0.05%. Now, there are solutions for you to maximize the growth of SRS to generate compounding returns. Now, for example, right now at Stashaway, we're offering up to 3.75% per annum on our fixed deposit product, Simple Guarantee. We also allow you to invest your SRS funds in the S&P 500, which is actually generally something you're unable to do elsewhere. And as I mentioned, S&P 500 has traditionally given investors a 9% return per annum. That's already significantly higher than the general 0.05% that you'll be yielding on a normal basis if the money was just kept in your SRS account. Now, as an investor, you're also able to invest your SRS funds in the following asset classes. What should an SRS investment strategy look like? First of all, it should be optimized for long-term investing because you're locked up. So that's because of that timeline that just exists. Now, assuming you're only starting today, so you may have a timeline of anywhere from 10 to 30 years, right, before you can withdraw penalty-free. This means you can take a slightly higher risk, perhaps portfolios with larger exposure to equities, or maybe even a direct exposure to equities itself, like the S&P 500, for example. Which kind of goes back to the earlier point, right? If I, when I ask like, what are some trends you're excited about? What is a trend that you feel like you want to bet on for the next 10, 20 years? This is your opportunity to use your SRS funds to actually do that. Next, how can one think about the SRS contribution and how do you actually prepare for this? Now, the first is to obviously ensure that you have set aside a budget. If you remember my monthly contribution slide earlier in the webinar, depending on the max amount you can contribute a year, you can break it up into different contribution amounts each month. So set aside a budget. And the beauty is that there's a fixed amount and a fixed time horizon. So you don't need to stress yourself out too much with this. And like most of our investment decisions, be sure to decide on a risk tolerance. Think about what you know, what you don't, what you're comfortable with, and what more you'd like to find out. And the good news is, as I mentioned, you can invest your SRS monies in stashaway products to start. Now, if you do decide that you're not ready to start yet, putting it into our cash management solution is also a good bet because as of today, the projected yield for both Simple and Simple Plus is higher than the SRS account rate of 0.05%. Now, otherwise, here's a general look on what your SRS funds are essentially missing out on just sitting in the bank, right? This is our performance last year. So good news that you're able to access all this via Stashaway. So you can invest your SRS funds and any of the products shown here on the screen in diversified portfolios, thematics, or cash management products in certain ETFs related to sectors or trends that you are ready to bet on for the next 10, 20 years. That's something that you're really, really excited on. I think what we're really trying to kind of drive home here is that don't leave your SRS funds. It's your retirement fund. Do not just leave it in the SRS account for the sake of just, nothing off your tax. Be sure to do something with those funds, right? Whether it's with Stashaway, whether it's with another provider that you're comfortable with, it doesn't matter. As long as you're investing those funds to get more than the 0.05% that the standard SRS account is giving you. Because ultimately, when you retire, when that's 10, 20, 30 years, the 15,000 or the 35,000 that you have set aside will not be enough because of inflation and general time value of money. So again, what we're really driving home today is be sure to really invest your SRS funds. It's your retirement income. It's locked up for the next 10, perhaps 20, 30 years. Don't just let it sit idle in the SRS bank account. Now, before we end off today's session, I just want to debunk some myths about SRS. This is really based on questions we get from some of our clients, and we do realize that there is a gap in information of what people think SRS is and how it works. So let's go through 4 of the more common myths for SRS. First of all, myth 1, SRS is only available or only Singaporeans or PRs are actually eligible, or only foreigners are eligible. The reality is all Singaporeans, PRs, and foreigners living in Singapore are eligible for an SRS account. So if you haven't started one just yet, just log onto one of the iBanking platforms or one of the local banks, DBS, OCBC, or UOB, and you actually be able to set it up really, really easily. Second, I'm too young to be eligible for an SRS account. Anyone over the age of 18 is actually eligible to open for an SRS account with their chosen bank. It's really never too early to start saving for retirement. So just remember that. Third, I can have multiple SRS accounts. That's actually a myth. You can only have one SRS account at any time. You can open, again, your SRS account with any one of the local banks, right? OCBC, UOB, or DBS. If you already have one with one banking provider, say for example, let's just use OCBC as an example. If you already have one account with them, you cannot open an account with DBS. So you're only eligible to one. The 4th myth is that I will incur a penalty when I withdraw from my SRS investments. That is not true. You will only incur a penalty if you withdraw from your SRS bank account. So there's a difference. You put money from your savings account into your SRS bank account. That's where you're locked up. From your SRS bank account, you deploy your investments to the various platforms that you choose. If you would like to switch platforms, investment providers, say for example, let's just use Stashaway as an example, right? So you've invested your funds in Stashaway Portfolio A. You decided, you know what, I want to switch to Portfolio B. You can do that. You won't incur any penalty. That's absolutely fine. Say for example, you're currently with 2 different platforms. You want to consolidate your SRS investments onto one platform. You withdraw from platform B to deposit into platform A, you will not incur any penalty. Penalty only kicks in when you withdraw from your SRS bank account. So just remember that, okay? So moving your investment funds across platforms, across portfolios, that's absolutely fine. You will not incur any penalty. You will only incur penalty when you withdraw the funds from the SRS bank account. Now, that's actually the end of today's webinar. I hope it was insightful. I do apologize for some of the technical difficulties that we had experienced earlier on. Um, this is a free investing code you get. We will help manage your portfolios for free, up to 50,000 of your next deposits for the next 3 months. Thank you for sitting through this. I hope I was able to provide some insights. If you have any questions about SRS or anything that I know I spoke about, if there's any further clarity you need, I know SRS was quite a heavy topic. I know market volatility is something that is quite scary for a lot of people. Please feel free to use the Q&A chat box the Q&A chat box here on Zoom. If you are on YouTube, please feel free to use our YouTube chat box as well. And at the same time, scan this to get free investing. This is also applicable for SRS funds. If you have any questions and you would like to get in touch with our client engagement team, you feel like you want to have a more private conversation, please feel free to leave your contact details with us. Let me just give it a few seconds to allow the questions to stream in. Let's see, how do I open the Q&A? Okay, let me just give it 2 seconds. If anyone wants me to run through any sort of SRS concepts, again, any questions about platform, the webinar, market volatility, personal finance, what trends I'm excited in, please feel free to post in the Q&A box. So let me just give it another 10, 20 seconds. So for those, while we wait for questions to come in, for those who are actually around in Singapore and you're interested to actually learn more about CPF as well as SRS, we actually have a real treat for you. We have an event happening at our office next week. So we have actually invited and we're partnering up with CPF, and CPF will actually be coming to our office to actually share a little bit more about some CPF basics. And if you would like to join us, please feel free to actually sign up. My colleagues will actually send the link into the chat box, both on YouTube as well as Zoom. Please feel free to join us for an evening with CPF. You can, if there are any sort of burning questions, I knew there were some recent changes to CPF. If there are any sort of burning questions that you may have, you can actually share it with CPF itself. And they will be able to answer it live. So my colleague will send the link into the chat box shortly. Feel free to sign up using that link, and the event will be held physically at office. There's also a webinar option. If you choose to actually join the webinar, feel free to do that. You want to sit in the comfort of your home, feel free to do that as well. It will actually be streamed live at the same time. Now, we have a couple of questions streaming in. Let me just take that one by one. Okay, what would you expect to be a developing trend that is undervalued? So for now, right now, house view wise, we are actually really bullish on Japan as well as India. And of course, AI, that's actually a really cool sector. So we actually do have, our portfolios actually do have exposure to all these three sectors already. In terms of something that's developing and currently undervalued, I think this is personal. It's not Stashaway's point of view. Personally, I'm super, super excited about blockchain. And I'm actually also very, very bullish on Vietnam. So Vietnam, actually the Vietnamese, we have a Vietnam ETF on our platform as well. So those are probably two trends and geographies that I'm actually genuinely excited about. Now, okay, can you advise which products in Stashaway we can invest that yields the highest returns from past performance so far? And each of their expected risks. It would be good to know if you could show the figures chart so that we could follow. Okay, so we can't actually advise, but what I can show you here is if you see right here on this chart, I hope that this is actually clear for you. This is actually a performance of our portfolios from last year. This is our general investing portfolio. So as you can see, the high risk portfolios actually average 16.5% returns. That's our SRI 36%, with the lower risk averaging for 5.1%. So what I would really suggest right now is instead of actually following where the highest um, returns are, I would really highly encourage you to just also understand. It will be also great for you to really understand what your personal risk profile is, because say for example, at SRI 36%, yes, it's great, right, to get 16% for the year. But there's also a 1% chance. So our statutory risk index basically means there's a 1% chance that the portfolio may lose more than percentage. So for example, SRI 36%, what that means is that there's a 1% chance. So it's very, very slim, but there is a chance that in a calendar year or in a financial year, that your portfolio may lose more than 36% of its value. Paper loss, unless you realize it by selling. But otherwise it's paper loss. So say for example, you had, invested $10,000 in SRI 36%. There's a 1% chance that your portfolio may be down more than 36%. More than 36% is about $360. Sorry, $3,600 if you had invested $10,000. So I think more than the returns, more than chasing returns, it's more important that you're comfortable with the risk that you're taking. Um, so yes, it's great to see the high returns. It's great to want to follow the returns. But if you're unable to stomach the potential risk that may come from investing from something high risk, then I would advise or actually suggest that you look at perhaps something a bit lower risk, like the cash management solutions that gives you something a little bit more steady. Perhaps if you're someone who would ideally like to get some passive income, recurring dividends, then you could look at the passive income portfolios. But over here is just really a guide. This was actually how our portfolios performed last year. So I hope that this will actually sort of give you some insights into what I'm trying to say. Uh, that said, I would highly encourage you to actually reach out to our support team, so that we can actually also understand your circumstance a little bit better, so that we can kind of talk through and how you can also make sense of risk, your timeline, as well as returns, in that regard. Because right now it's a very general question. It's honestly very hard for me to give a very, very specific answer, because your circumstance is very different from my circumstance and the person next to you, for example. Yeah, so I would highly encourage you to sort of leave your details with us, and then our team will actually reach out to you to really, really understand a little bit more of what your current circumstances, number one, and number two, what perhaps would be a little bit more appropriate for you. So this is a QR code for you to leave your details. Second question, would you advise someone in their 30s with Oh, sorry. What would you advise for someone in their 20s to 30s with 500K to 1 million to invest, and how to diversify if they wish to surpass the interest rate that's the simple products can surpass? Okay, so I would assume that what you're asking is that, an individual in their 20s and 30s, you currently have $5,000 to a million to invest, and how would you actually diversify these funds if they wish to surpass the interest rates that simple products can surpass? Meaning if you want to actually earn more than simple products. I'm just going to assume that that's your question. I would actually encourage you to check out like our diversified portfolios, because that gives you a broader exposure to the markets. It actually helps you actually invest in the markets. Our simple products are more bonds as well as money market funds. So it's very steady. A simple, for example, has never had a negative day. Simple Plus has some volatility, but it's still much, much lower risk compared to exposing yourself in the markets. If you're someone in the 20s and 30s and you have that amount of money, your wealth is still going to continue to grow, because you have another, say, good 20, 30 years ahead of you where you can work and earn money. So perhaps you're someone who can take a little bit more risk. So I would highly encourage you to check out our general investing by statutory portfolios. It gives you a much, much broader exposure to equities. It gives you a much broader exposure to the market. Geographically, you're more diversified, so you'll be able to actually, partake in certain trends and market growth as well, to help basically grow your wealth in that regard. But I wouldn't put all your funds into one portfolio. I would actually split it up, perhaps, X% in a specifically GI portfolio to get some equities exposure. Put some funds obviously in a passive income portfolio that we have as well, and perhaps put some, in flexible portfolios where you invest in specific trends and ETFs that you may be interested in. So I would strongly advise diversification across, and not just put all the funds into into one basket. That's number one. Number two, if you have this amount of money, I would imagine you're probably an accredited investor. You might want to look at perhaps some private market stuff, because that's obviously, if you're in your 20s and 30s, you have a longer term horizon, or I would assume you have a longer term horizon. You could potentially expose yourself to some private equity as well as venture capital. So, it might be actually good to give yourself exposure into the private markets as well. Yeah, so if you are an individual under this circumstance, we would love to actually also understand a little bit more about how we can help you. Perhaps private markets can be an attractive thing for you. There's private credit now. There's private equities, which obviously, as I mentioned, is obviously a much longer timeline, 7 to 10 years. And there's also venture cap. So these are actually really exciting for someone with this amount of capital to spare. So feel free to get in touch with us. We would love to also, understand a little bit more of the circumstance and how we can help you in that regard. So I hope that answers your question. Okay. We have some questions in the chat box itself. Let me just answer that. We're slightly over time. So I'll just answer this three and then we can call it at 9 and everyone can go get some dinner. All right. The first thing, can you advise on investment of CPF stash away funds? Unfortunately, right now we don't actually have CPF, meaning you can't actually invest your CPF funds on stash away. Unfortunately, that's at this point, we're working on it. But you can't actually invest CPF with stash away just yet. But if you have SRS, then you can actually invest your SRS funds. Second question, what is your best monthly income fund? Okay, so we don't actually have funds per se. We have portfolios. So we have two options. We have Singapore investing fund. So that actually is exposed to Singapore specific REITs that gives you dividends. And then we have our passive income that's under flexible portfolios. And within the passive income, you can actually choose between a slightly more conservative portfolio and a slightly higher risk portfolio. But they're both passive income, so you can actually explore these three. I don't unfortunately have the returns off the top of my head, but you can actually look for the returns on our platform itself. On the flexible portfolio, if you go to flexible portfolio and choose templated portfolios, you would see passive income. If you click on that, you can actually also see the simulation of what your potential capital may be with the projected income. Question from Jesslyn: how do you spot undervalued markets if you want to start investing? So this is something I do. At your own risk. This is not Stashaway's point of view, because I know the investment team has their own motto. Obviously, from the investment team side, they do a lot of research and they make sure that, because we have a duty to you, our investors, right? So we make sure that we actually invest in things that we've done a lot of due diligence in. For me, I invest like I'm a venture capitalist. I look at specific companies. I look at specific sectors I'm interested in. I look at things that I understand and I invest. So even though something might be undervalued, say for example, I think one of the big things recently was cybersecurity. I understand cybersecurity as a concept. I do not know much about the industry, so I actually stayed away from cybersecurity. So what I basically am sharing is that kind of look at it as, okay, what you're interested in, what you can actually, and do a lot of research. If you spot, say, a trend or a specific company and do a lot of research in the company, really understand who the management is, what their product is before you actually make an investment. That is why actually investing in specific stocks can be very tedious. That's why we really encourage ETFs. Because say, for example, you're interested in AI and you think and you read articles and you think that AI is something extremely undervalued, the amount of effort that it's going to take for you to actually look for one AI company to invest in is a lot. So why not just invest in an ETF, an AI ETF, where you have exposure to perhaps the top 20, 30, 40, 50 companies in AI, and there's a professional fund manager actually doing the rebalancing for you. But going back to your question, I kind of digress a little bit. Going back to your question, how do you actually spot? I think it's really just looking at a specific market or a company. If it's an industry that you love and you understand, it doesn't necessarily need to be undervalued, right? Because as long as you have conviction about a specific trend or a market, it should be comfortable enough for you to actually invest in. Spotting undervalued markets is a very, very technical thing to do. There's a lot of calculations. Um, it can be very, very technical unless you have a background, unless you have the time to really sit down and look at all the P&L of like specific companies and specific markets. It can be a very, very hard thing to do. So I think what I would suggest is really for you to look at specific industries, sectors, geographies, companies that you genuinely understand and are interested in, and then perhaps take a chance on them and see how that kind of works out for you. Um, okay, let me just take two more and then I think we'll call it a night. So can you explain more on what money market funds, ETF bonds, and different types of bonds are short? SSB. Okay, so this is relating to our simple cash management portfolio. Um, ETFs are exchange traded funds. Um, they are basically a basket of equities that fund managers actually kind of put together into one fund for you to invest in. So say, for example, let's take the S&P 500 as an example, right? So the S&P 500 is an exchange traded fund that consists of the top 500 largest companies in the US. So instead of you actually going to look at all the top 500 companies and then investing in them one by one, which first of all is a lot of time, secondly is a lot of capital, you just buy S&P 500 with, and right now today we have the concept of fractional shares. So you can invest $100 and your $100 is basically split across these 500 companies. So it's become more convenient than ever. You're able to actually gain exposure, a wider exposure versus just going to one company. So that's why I mentioned earlier on, right? If there's a specific trend that you're interested in, let's not use AI. Let's talk about blockchain, or car automotive, right? Someone had brought up car automotive earlier on. If you're very interested in the automotive industry, um, it's going to be very hard for you to also kind of look at one, two, three vehicular or automotive companies and invest in them is a lot of time and effort, and a lot of capital. Versus, say, for example, if you look for a specific exchange traded fund, that is usually and ideally managed by a well-known fund manager, then you can take this opportunity to invest in that specifically ETF that would potentially already have, let's say, the top 20, 50, 100 automotive companies in that. So that actually makes life a lot easier for you. And it's at a much, much lower cost because it's only one transaction, right? I mean, obviously, if you invest in digital platforms like Stashaway, it's just a management fee, it's not a transaction cost. So you can actually do your dollar cost averaging. Um, to kind of go into bonds itself, that's a lot of explanation. So I'll just kind of go very high level. So there are corporate bonds and then there are government bonds. The concept of bonds is basically you lending money to a specific either entity or the government. So what happens is I give you capital with the intent of you giving me yield. Um, the common term is principal, that's your capital, coupon, which is basically the interest, and maturity, which is, the time horizon of the bond. It can be anywhere from 1 year, 2 years, 10 years, 20 years. It depends. It really depends on what the company or the government has set it up to be. Basically, the concept of bonds is I will lend you money, and then you will actually return me a yield, and then upon maturity, you actually return your capital to me. That is the concept of bonds. If, say, for example, a corporate bond would have a much higher risk compared to a government bond because the likelihood of a corporate actually defaulting is much higher than the government. So because of that, corporate bonds historically tend to give you much higher yield compared to, like, say, a government bond, because governments are obviously, steadier, or much safer. But obviously within country to country, the risk profile also differs. So, here in Singapore is viewed as one of the highest grade bonds in the world. I think Singapore is rated AA plus, I believe. I could be wrong, but they're quite high. We are quite high up. I think we're about AA. So the yield a Singapore government bond will give you is actually quite low because the chances of Singapore defaulting is very, very low, compared to I'm sorry, I'm just going to use like a random African country, Uganda, for example, right? Or Nigeria. So those are considered a much, much higher risk. The government bonds are rated much, much lower. So if you were to invest in a Nigerian government bond, for example, you would potentially be given higher yield. But obviously, the chances of the Nigerian bond defaulting versus a Singapore government bond is much higher. So there's also various risks between bonds itself. Money market funds are essentially funds that actually invest in cash itself, for lack of a better way to describe it. That's why simple is actually very safe. Um, it's never had a negative day. And it's basically also managed by experienced fund managers. So that's very high level. It would take a long time for me to really explain, but I would actually love to for our team to be able to help you understand it a little bit better, because I think it's extremely crucial and fundamental for one to understand this before actually making an investment decision. So for this anonymous attendee, I would highly encourage you to just leave your details as well, and allow our team to kind of explain and, really also answer any sort of other questions that you may have. Because the goal of this series is really to help you learn as much as possible before if you have not started to make your first investment decision. Um, so yeah, really, please leave your details. We would love to hopefully see some of you at our event next week. I think my colleagues have actually sent the CPF link already. And for those who, a little bit more shy, you want to just speak over the phone, that's absolutely fine as well. This QR code in front of you, scan it, leave your details, and our team will get back to you in the next few days. And with that, thank you so much for sitting with me until 8:15. I hope this was a helpful session. Once again, if you have any questions, we are at support@stashaway.com. If you would like to start investing, have not started investing, please feel free to use this QR code for free investing. It's also applicable to your SRS funds. If you have missed it, you would like us to apply it, also just reach out to our team. We will happily apply it manually in your account for you, because ultimately we would love for everyone to really start investing. If you need any sort of walkthroughs, if you need any help, use this code. Our team's available to help you through anything. And with that, thank you so much for your time, and good night, everyone. Hopefully see you very soon. Hopefully see some of you at our CPF event next week. If you're coming, please feel free to come up, say hi, and give me feedback in person. I would love to know how we can actually make this more informative for everyone. That's it. Thank you, everyone. Good night.